In this video, we'll continue our discussion of accounting for merchandising activities. Previously, we've looked at the difference, the idea there's two basic systems of accounting for merchandise inventory, being a periodic and perpetual system. In a previous video, we actually looked at the accounting entries associated with a perpetual inventory system, where we perpetually update the inventory account and perpetually update the cost of goods sold account, or continuously update them. Today we're going to focus our attention on the periodic system, where we only update the inventory account and the cost of goods, determine the cost of goods sold periodically rather than continuously. The entries look very much the same, but you'll notice some differences in the accounts that we actually use. Let's start off with we actually purchase some inventory. So, under the perpetual system, which you will see, we're perpetually updating or continuously updating inventory. When we purchase inventory, we debit the inventory account and credit accounts payable. Under the periodic system, we don't touch the inventory account. We don't make any entries to the inventory account throughout this process. We actually use other accounts to sort of store numbers temporarily that have to do with inventory and the cost of goods sold. And so the first account we're introducing here is the purchases account. Now, purchases, you may have heard that term before, where we purchase or buy something. In a merchandising company, the account purchases is used specifically to record the purchase of items that we plan to sell to customers. No other purchases go in there. For instance, if we were to buy photocopy paper for use by our own company, that would be office supplies. It would not be purchases. If we bought photocopy paper to sell to our customers, that would go into purchases. So be very careful about when you use that account. So rather than updating inventory, we record the debit to an account called purchases, and we record the accounts payable. Okay. So and watch for, as we do this little comparison entry, you'll see the differences in accounts. Some similarities, some differences. So, for instance, if we return some merchandise to whoever we bought it from, we would see a reduction of our accounts payable, much as we do under the perpetual system. But in the periodic system, we don't update inventory as we did in the perpetual system. In the periodic system, we record it in an account called purchase returns. Now, you might wonder about why didn't we just reduce the purchases, since we bought it and then we sent it back. Well, it turns out that much like we want to keep track of when we sell things to our customers, how much of that material comes back to us, we don't like it coming back to us, and so there's a lot, we know there's a problem. The same thing, if we find out that we're purchasing a lot of stuff and then sending it back to our suppliers, that could indicate some sort of problem with the quality of the merchandise from our supplier or some other problem. So we want to know that information on an ongoing basis. Next part of the example, then let's assume that we buy the stuff and now we've been offered the discount. I'll remind you the 2/10 and 30, remember 2% discount if we pay within 10 days, the balance due in 30 days if we don't take the discount. Under the perpetual system, we would have reduced the cost of our inventory, because that discount meant that that inventory didn't cost us $900, it actually only cost us $882. So we would have reduced the inventory account. Again, we're not under the periodic system. We don't perpetually update inventory, so we don't make an entry to inventory. We actually keep track of the number of discounts that we take on anything that we purchase for sale in an account called purchase discounts. We'll see where these accounts all come into play when we start a little later, when we look at the format of income statements and the calculation of cost of goods sold. But realize that for now, we're under the perpetual system. We were continuously updating the inventory account. Under the periodic system, we actually have separate accounts for almost every kind of transaction that we do. So here, the purchase discounts go into purchase discounts account. What about freight charges? So we bought merchandise and we were charged the freight in, or the transportation cost of having it delivered to us. In the perpetual system, we would have seen that as an additional cost of inventory and updated inventory. But under the periodic system, where we don't update inventory, we record it in an account called transportation in, or freight in, or freight charges. Just an account that describes the cost of the transportation cost of getting goods from our supplier to us. I want to remind you about this little diagram where we're kind of keeping track of all the costs of the things we buy, things we had, plus anything new we bought, and then where does that end up? It either becomes part of cost of goods sold, or we still have the inventory. Just kind of keep that in mind as we move on to the next element. Under a periodic system, the calculation of the cost of goods sold is actually a calculation. Under the perpetual system, we were perpetually or continuously updating an actual general ledger account called cost of goods sold. We didn't do that or we don't do that as we sell things to our customers here. But under the periodic system, we do occasionally have to determine that. So under the periodic system, the way we determine the cost of the goods that we sold is by figuring out what we paid for everything and subtract from that what we still have. That means everything else has been sold. So think about the accounts that we've been using in the transactions. We start off with the inventory that we had at the beginning of the year, plus the purchases, all the goods we bought to sell to our customers, plus any transportation costs or other costs to get it ready to actually sell to our customers. We subtract from that any discounts that we got. Remember, purchases discounts was one of the accounts we had, and so it turns out what we paid, what we were charged for it, minus any discounts or returns or things we sent back. What we end up with then is that's the value of all the goods that we had plus the value of all the goods that we purchased during the year, and that's the goods we have available for sale. Then we check to see how much of that stuff we still have. It's much like if you bought a full tank of gas for your car and then you check the gauge and the gauge says you only have a quarter of a tank, you know that you've used 3/4 of a tank of gas. Here, we had a whole bunch of inventory. We check to see how much we have. That tells us how much we've actually sold and gives us the calculation for cost of goods sold. This actually appears as a major section of the income statement of a merchandising company that uses the periodic system. So what happens when we sell stuff? Okay. Not surprisingly, when we sell something to a customer, we debit accounts receivable and we credit sales. We did that in the perpetual system and we did it in the periodic system. Under the perpetual system, we had, though, this second part of the entry where we had to record and update inventory for the fact that we don't have that inventory anymore. We reduced the inventory and transferred that to the cost of goods sold. Because we're not perpetually updating those accounts, there is no entry associated with that. There's only the recording of the receivable, the amount we'll receive in the future, what we charge the customer, and the crediting of the sales account. Okay. So this is the material going from the customer, or from us to the customer. And what does a return look like? You can probably guess already. But when we return stuff, we have the debit account called sales returns, where we're keeping track of how much merchandise our customers return to us, and we credit the customer's account for the $800 that they don't owe us, so we reduce the amount owing. We did the same thing in the perpetual system, but remember, in the perpetual system, we also had an obligation to update inventory, merchandise inventory, or cost of goods sold. Once again, because we're not doing that under the periodic system, there is no second part of that entry. This takes a while to kind of get your head around, get used to the names of the accounts and what they're all about. And so I'd encourage you to take a look at exercise 612 and 621 and QS 618. These focus on what the actual transactions are in a periodic system, as well as calculating that cost of goods sold, that little more complicated cost of goods sold calculation that happens for companies that use the periodic system.